Have you ever heard of Bitcoin? For most people, the first time they hear that word, it's tied to something strange. Maybe a headline about someone getting rich overnight. Or a warning about scams, bubbles, and spectacular crashes. Or maybe it was a friend who just casually said, "You should buy some Bitcoin," without really explaining why. So, before we dive into how Bitcoin works or whether it's a good investment, let's slow down and ask a much simpler question. Why does Bitcoin even exist? To answer that, we need to go back in time, not to technology, but to money itself. For most of human history, money was something physical. Gold, silver, shells, even stones. These things had value not because a government said so, but because we all agreed they were scarce, durable, and hard to fake. But carrying around physical money became a hassle, so we invented banks. Banks promised to keep our money safe and make it easier to move around. Eventually, our money became mostly digital. Just numbers on a screen, a balance, and an account. And for a long time, that system seemed to work just fine. Most of us never really questioned it. Until the cracks started to show. Banks could freeze your account without warning. Governments could print more money whenever they wanted, causing inflation that quietly ate away at your savings year after year. Financial crises would pop up, disappear, and then come roaring back. And every single time something went wrong, it was ordinary people who paid the price, while the system itself stayed the same. Then came 2008, during one of the biggest financial crises in modern history. Trust in the traditional system was shattered. Banks collapsed. Secret bailouts happened behind closed doors. And a lot of people started to ask a very dangerous question. What if money didn't need banks at all? That was the moment Bitcoin appeared. It didn't come with a big announcement or a marketing campaign. It was just a simple 9-page document published online by someone using the name Satoshi Nakamoto. No photos, no interviews, no real identity. Just an idea. And the idea was radical in its simplicity. What if we could create digital money that didn't require us to trust any single company or government? What if ownership could be proven with math instead of relying on an authority? What if money could move directly from one person to another, anywhere in the world, without needing permission and without anyone in the middle? Bitcoin was never meant to be a company. It wasn't designed as a product to be sold. It didn't promise profits or guarantees. Bitcoin was, and still is, a question. And that question is, can we design a form of money that works without needing to trust other humans? At its core, Bitcoin is simply a digital form of value. But unlike the money in your bank account, Bitcoin doesn't live inside a bank. It doesn't belong to a corporation or a government. It exists on a global network of computers that anyone can join and that no one person or group can control. This is where a lot of people get confused. They try to imagine Bitcoin as an app, a website, or some kind of platform. But Bitcoin isn't any of those things. It's a protocol, a set of rules. Think of it like the internet itself. No single person owns the internet. No one can just decide to turn it off for the whole world. And no single country gets to control how it works. Bitcoin was designed with that same spirit. Instead of trusting a central authority like a bank to keep track of who owns what, Bitcoin distributes that job across thousands of computers all over the world. Every single transaction is recorded, verified, and shared publicly. And once a transaction is recorded, it can't be changed or erased. This might sound technical, but the idea behind it is deeply human. Bitcoin is about removing the need for blind trust and replacing it with something you can see for yourself. Transparency. When you use a bank, you're trusting them. You trust that the numbers on your screen are real. You trust that the bank will let you withdraw your money when you want to. You trust that your account won't be frozen for some unexpected reason. And you trust that inflation won't destroy your savings too quickly. Bitcoin doesn't ask for that kind of trust. Instead, its philosophy is, don't trust, verify. Every rule in the system is open for anyone to see. Every transaction is visible on the public ledger. Every single person, whether you're a billionaire or a student with just $10 worth of Bitcoin, plays by the exact same set of rules. There are no special exceptions. This is why Bitcoin can feel so strange at first. It doesn't fit neatly into the boxes we're used to. It's not just money. It's not just technology. And it's not just an investment. It's a completely new way of thinking about value, ownership, and even freedom. But at this point, a reasonable person might ask another question. If Bitcoin is just digital money, what stops someone from just copying it over and over? What prevents cheating? How does it stop fraud? That question takes us right to the heart of how Bitcoin actually works. And to understand that, we need to talk about something called the blockchain, not as a complicated buzzword, but as a simple, elegant solution to a very old problem. In the next part of our journey, we're going to strip away all the jargon. We'll walk through how Bitcoin works, step by step, in plain language, until the whole system makes sense, even if you've never cared about technology before. Because Bitcoin, at its core, isn't really about computers. It's about people. So we've talked about why Bitcoin was created. But how does it actually work without getting lost in all the technical jargon? At first glance, the whole idea of Bitcoin seems impossible. If there's no bank, no company, no central server, then who keeps track of all the money? Who decides which transactions are real? And how do we stop someone from just spending the same money over and over again? These aren't small questions. In fact, they're the exact problems that made digital money impossible before Bitcoin came along. The solution, believe it or not, lies in something surprisingly simple. Imagine a notebook. This notebook records every single Bitcoin transaction ever made. Who sent Bitcoin, who received it, when it happened, and exactly how much was transferred. Now imagine that this notebook isn't stored in just one place. Instead, thousands of people all around the world each have an identical copy. And every time a new transaction happens, everyone updates their notebook at the same time. That shared notebook is called the blockchain. The word might sound complicated, but the concept really isn't. It's just a public record that anyone can see, anyone can verify, and no one can secretly change. Each page in this notebook is called a block. Each block contains a list of the most recent transactions. Once a block is full, it gets sealed, and then digitally linked to the block that came before it. That's where the name blockchain comes from. It's literally a chain of blocks, each one connected to the last, and each one protecting the integrity of the entire system. If someone tried to go back and change an old transaction, they would have to rewrite not just that one block, but every single block that came after it. And they'd have to do it faster than the rest of the entire global network combined. In practice, this makes cheating almost impossible, but that still leaves another question. Who decides which transactions get added to the blockchain in the first place? This is where Bitcoin introduces a concept called mining. Now, despite the name, Bitcoin mining has nothing to do with digging in the ground. It is a process where powerful computers all over the world compete to secure the network by verifying transactions and grouping them into new blocks. These computers are called miners. Miners take all the recent Bitcoin transactions and check to see if they follow the rules. Does the person sending the Bitcoin actually own it? Has that Bitcoin already been spent? Is the transaction valid? Once the transactions are verified, miners then compete to add the next block to the blockchain. They do this by trying to solve a very difficult cryptographic puzzle. The puzzle is hard, but the rules are simple. The first miner to solve it earns the right to add the new block. As a reward for their work, that miner receives newly created Bitcoin, along with any transaction fees from that block. This entire system is called proof of work. The work is the computational effort and electricity required to solve the puzzle and secure the network. And that effort is what gives Bitcoin its security. It makes attacking the system extremely expensive, while honest participation remains profitable. Here's the really important part. Miners aren't trusted because they're good people. They're trusted because the system makes it irrational for them to cheat. If a miner tries to break the rules and submit a fraudulent block, the rest of the network simply rejects it. They waste electricity, time, and money for nothing. Honesty is rewarded. Dishonesty is punished. This is a fundamental shift from traditional systems. Banks rely on trust and authority. Bitcoin relies on incentives and mathematics. Now let's talk about ownership. When you own Bitcoin, you're not holding a physical object. What you hold is a cryptographic key. This key is the proof that you have the right to spend certain Bitcoin recorded on the blockchain. Think of it like a password, except far, far more secure. If you control the private key, you control the Bitcoin. If you lose that key, the Bitcoin is effectively gone forever. There's no customer service to call, no password reset button, and no recovery email. This idea is uncomfortable for many people at first. We're used to systems where someone else can step in and fix our mistakes. Bitcoin doesn't work that way. It gives you complete control, and with that control comes complete responsibility. This is why you'll often hear the phrase, "Not your keys, not your coins." If your Bitcoin is held by an exchange or some other third party, you are trusting them. True ownership means holding your own private keys. Another important feature of Bitcoin is its transparency. Every single transaction is public. Anyone can look up the blockchain and see exactly how much Bitcoin moved between different addresses. What remains private is the identity behind those addresses. The addresses are not directly tied to real-world names. This creates a fascinating balance between openness and privacy. The system can be audited by anyone, at any time, yet individuals don't need to reveal who they are. At this point, you might be noticing something interesting. Bitcoin isn't fast in the way we think of modern apps being fast. It's not cheap in the way digital payment services are cheap. And it's definitely not designed for convenience above all else, and that is completely intentional. Bitcoin is optimized for security and decentralization, not speed. It prioritizes being incredibly hard to break over being easy to use. This design choice often confuses newcomers. They compare Bitcoin to their credit cards or mobile payment apps and conclude that it's slow and inefficient. But Bitcoin isn't trying to replace those systems directly. Bitcoin is trying to replace trust, and that changes everything. So now we have a better understanding of what Bitcoin is and how it works on a technical level. But that still leaves one major question. Why do people believe it has value? Why do millions of people around the world treat this digital code as something worth saving, protecting, and holding for the long term? To answer that, we need to talk about scarcity, inflation, and why Bitcoin is so often compared to digital gold. That's where the story goes next. So, we've covered the basics of how Bitcoin works. But that leads to the big question. Why does it have any value at all? I mean, you can't hold it. You can't build anything with it. And unlike a dollar or a euro, it's not backed by any government. So why do millions of people all over the world treat these digital bits and bytes as something precious? The answer in a word is scarcity. Think about it. Throughout history, the things we humans have valued most tend to share one key trait. They are hard to get. Gold didn't become valuable just because it was shiny. It became valuable because it was rare, difficult to mine, and almost impossible to counterfeit. Bitcoin was designed with that exact principle at its core. There will only ever be 21 million Bitcoins. Not around 21 million, not 21 million for now. Exactly 21 million. This isn't just a promise. It's a rule written directly into the code. No central bank can change it. No politician can print more. No emergency meeting can override it. The supply is fixed. New Bitcoins are created through a process called mining, but there's a catch. The rate at which new coins are made gets cut in half roughly every 4 years. This event is called the halving. Over time, fewer and fewer new Bitcoins enter circulation, until eventually, around the year 2140, no new Bitcoins will be created at all. This makes Bitcoin fundamentally different from the money we use every day. Governments can and do create more money whenever they see fit. Sometimes this is necessary to manage an economy, but often this power is overused, leading to inflation. Inflation is that silent thief that slowly erodes the value of your money. You might not notice it from day to day, but over a few years it becomes impossible to ignore. That $100 you saved buys less and less. Your savings are quietly losing their power, forcing you to take bigger risks with your money just to keep up. Bitcoin offers a different path. Its supply is predictable, transparent, and unchangeable. Anyone on the planet can verify the total supply and the rate of new issuance. You don't have to trust a politician or a central banker. You can trust the math. This absolute verifiable scarcity is the main reason Bitcoin is so often compared to gold. It's why many people call it digital gold, but the comparison doesn't stop there. In many ways, Bitcoin has advantages that physical gold just can't match. Gold is heavy. It's a pain to transport across borders. It's expensive to store securely in a vault. And trying to pay for a coffee with a tiny shaving of a gold bar? Good luck with that. Bitcoin, on the other hand, is weightless. It can be sent anywhere in the world in minutes for a fraction of the cost of moving gold. It can be divided into 100 million tiny units, so you can use it for large or small transactions. It can be stored in your head as a string of words, written on a piece of paper, or secured with powerful cryptography on a device the size of a flash drive. It doesn't need a physical vault or armed guards. This combination of digital scarcity and extreme portability is incredibly powerful. Now, if you live in a country with a stable economy and a reliable banking system, you might be thinking, this all sounds interesting, but I don't really need it. And you might be right. But for millions of people around the world, Bitcoin is not a luxury. In places experiencing hyperinflation, strict capital controls, or political chaos, A reliable store of value that can't be seized or devalued by a government isn't just a speculative investment. It's a lifeline. It's a tool for preserving the value of your life's work. This brings us to another revolutionary idea embedded in Bitcoin. It's permissionless. You don't need anyone's approval to use it. You don't have to open an account, fill out forms, or prove your identity. As long as you have an internet connection and a Bitcoin wallet, you can be part of this global financial network. This isn't just a technical detail. It's a profound philosophical statement. At its core, the Bitcoin protocol treats every single person on Earth equally. There are no special privileges, no VIP accounts, no discrimination. Everyone plays by the same rules. This inherent fairness is a huge part of why Bitcoin has attracted such a passionate and diverse community of supporters. For them, it represents a level playing field in a global financial system that often feels rigged. Of course, Bitcoin isn't just being held as a digital savings account. People are actively using it. They're sending money to family across borders, bypassing slow and expensive banking systems. They're using it for online purchases where traditional payment methods aren't available. And they're holding it as a hedge against economic uncertainty, a sort of digital insurance policy. But let's be honest here. Bitcoin isn't perfect, especially not as a currency for your daily coffee. Its price can be extremely volatile. What buys a pizza today might buy a car next year, or it could be worth half as much tomorrow. Transaction fees can also spike when the network gets busy, making small payments impractical. And let's face it, getting started with Bitcoin can still be pretty intimidating for a total beginner. This is why, for now, many people see Bitcoin less like digital cash and more like a long-term asset like digital gold. They save it. They hold on to it, betting that as more people understand it and as the technology improves, its value and utility will grow over time. Some critics argue that if nobody is spending their Bitcoin, then it has failed as a form of money. But history offers a different perspective. For most of human history, gold wasn't used for daily shopping trips. It was held as a reserve asset, the solid foundation upon which entire monetary systems were built. Bitcoin might be following a very similar path. First, it proves itself as a reliable store of value. Then, as the technology and infrastructure around it improve, it becomes easier and more practical to use for everyday transactions. Its role can evolve. But it's crucial to keep a balanced view. Bitcoin is not risk-free. The price volatility is very real. The regulatory landscape is still being figured out in many parts of the world. And like any new technology, its long-term success is not guaranteed. And that brings us to the final critical part of this story. To truly understand Bitcoin, we have to be willing to look at its flaws, listen to its critics, and examine the challenges it still has to overcome. Only then can we make an informed decision about what Bitcoin really represents, and what role, if any, it should play in our own financial lives. And that's exactly where we're headed next. By now, you've probably heard a lot about Bitcoin. And depending on who you ask, it's either an inspiring revolution or a reckless gamble. Maybe you feel a bit of both. If you do, that reaction is completely normal. Bitcoin challenges assumptions we've lived with for generations. It makes us ask tough questions. Who should control money? How is trust established in a digital world? And what does it even mean to truly own something? But to understand Bitcoin, we also have to be honest about its limitations. Here's the thing. Bitcoin is not perfect. And it was never meant to be. One of the most common criticisms you'll hear about Bitcoin is its volatility. The price can soar to incredible heights, only to fall just as quickly. For many people, this makes Bitcoin feel unreliable, unpredictable, and even dangerous. And you know what? That's a fair criticism. A currency that changes values so rapidly is difficult to use for your daily coffee or weekly groceries. It makes planning for the future harder. The risk is higher and it's easy to get swept up in emotional decisions. However, volatility is often a feature of something new and disruptive. Think about it. Bitcoin is still a teenager compared to traditional financial systems that have existed for centuries. As more people adopt it and the market matures, many believe this volatility will eventually decrease. Whether that actually happens or not, well, that remains to be seen. Another huge concern is energy usage. You've likely seen headlines about how much electricity Bitcoin mining consumes. Critics argue that it's wasteful and environmentally harmful. On the other side, supporters counter that a significant portion of this energy comes from renewable sources. They also argue that Bitcoin provides powerful incentives to develop more efficient energy infrastructure, especially in remote areas. So, what's the truth? As with most things, it probably lies somewhere in between. Yes, Bitcoin does consume a lot of energy. But energy consumption alone doesn't determine something's value. The global financial system we use every day also consumes enormous amounts of energy, from powering bank branches and data centers to printing physical cash. It's just less visible and harder to measure. The real question we should be asking is whether the value Bitcoin provides is worth the cost. And that answer is going to be different depending on who you ask and what they value. Then there are the misunderstandings about anonymity. Bitcoin is often described in movies and news reports as anonymous, untraceable digital cash. But that's not entirely accurate. Bitcoin is actually pseudonymous. Every transaction is recorded on a public ledger that anyone can view. While your real name isn't attached to your transactions with enough analysis, it's sometimes possible to link identities to Bitcoin addresses. This transparency is intentional. It's what allows the system to be audited and trusted by everyone, without relying on secrecy. Privacy tools do exist for those who need them, but the core Bitcoin protocol prioritizes openness over invisibility. Another major hurdle is usability. Let's be honest, for someone new to the space, Bitcoin can feel incredibly intimidating. You hear terms like wallets, private keys, backups, transaction fees, confirmations. It's a whole new language. And the stakes are high. Mistakes can be costly, and unlike a bank transaction, they are often irreversible. This is a serious barrier to wider adoption, but think back to the early days of the internet. It faced similar challenges. Dial-up modems, command line interfaces, and confusing protocols made it difficult for the average person to use. Over time, layers of user-friendly design emerged, making incredibly complex systems feel simple and intuitive. The infrastructure for Bitcoin is still evolving. Every day, developers are building new tools and services on top of the base layer to make it easier and safer for everyone. And of course, there's regulation. Governments all around the world are still trying to figure out how to handle Bitcoin. Some countries are embracing it, creating frameworks for it to grow. Some are restricting it heavily. And many are still just watching from the sidelines. This uncertainty creates risk, especially for businesses and large institutions that need clear rules to operate. But regulation can also be a double-edged sword. Clear rules can bring legitimacy, stability, and attract broader participation from the mainstream. Bitcoin doesn't need a government's permission to exist, but its interaction with the traditional financial world will inevitably involve legal frameworks. Despite all these challenges, the volatility, the energy debate, the learning curve, and the regulatory uncertainty, Bitcoin has survived. In fact, it has thrived. It has been declared dead by critics hundreds of times. It has been attacked, misunderstood, and dismissed. And yet, block by block, hour by hour, it continues to operate exactly as it was designed to. This resilience is not an accident. Bitcoin was designed to be anti-fragile. It learns from stress and failure. Bad ideas and weak points get exposed and are eventually removed by the community. Strong ideas remain. The system evolves, but it does so slowly, cautiously, and deliberately. And that brings us to the most important point of all. Bitcoin is not a promise of instant riches. It is not a get-rich-quick scheme or a shortcut to wealth. And it is certainly not a guarantee of anything. Bitcoin is a tool. And like any powerful tool, it can be used wisely or it can be used poorly. It can be used to empower people or to mislead them. It can be used to protect wealth or to expose you to risk. What matters most is not blind belief, but genuine understanding. You don't need to love Bitcoin. You don't need to own it. You don't even need to agree with its underlying philosophy. But in a world where our money is becoming increasingly digital, centralized and controlled, Bitcoin represents a meaningful alternative. It's an alternative that invites us all to rethink fundamental assumptions about money that we rarely ever stop to question. Perhaps the greatest value of Bitcoin isn't its price on any given day. Maybe its greatest value is the conversation it has started. A global conversation about trust, about freedom, about personal responsibility, and about the very future of money itself. Whether Bitcoin ultimately becomes a global reserve asset, a niche digital gold, or something else entirely, its existence has already changed the way we think about finance forever. And once that door has been opened, it can never be fully closed again.